Today, I'm breaking down the Federal Reserve's December 2025 rate cut and the real tension behind it, and at the end, I will explain what it means for the households. This decision is about one thing: balancing jobs and inflation. Here, the Fed is trying to thread the needle, which means support the economy without letting prices hit up again. So here is the big question behind this move. Can a rate cut help protect jobs without rising inflation again? Rate cuts can make borrowing cheaper, which can support spending and hiring. But if people and businesses spend too quickly, prices can rise again and inflation can come back. This is basically the Fed's dual mandate in one sentence. On one side is maximum employment, on the other side is price stability. So whenever the Fed changes interest rate, it is choosing how to balance that trade-off. Why cut now? The case for cutting now is mainly about jobs because the labor market has started to cool. As shown in the graph, unemployment has gone up to mid 4% range. A small rate cut works like insurance. It can make it cheaper for businesses to borrow and invest so hiring does not weaken further and layoffs do not spread. But jobs are only half of the story because inflation is still not back to normal. Inflation is much lower than the peak we saw in 2022, but it is still above the Fed's 2% goal. Right now it's around 3%. This is not out of control, but this is high enough to keep the Fed cautious. There is risk on both sides. If the rate is cut too fast, the inflation could rise again. If it's cut too slow, the labor market could weaken further. That's why the market focuses on one key idea: long-term inflation expectation. What are inflation expectations and why are they important? Inflation expectations are basically what people and businesses believe inflation will be in the future. In order for this rate cut to serve its purpose, it's important that inflation expectations remain anchored. That means people hold the belief that inflation will settle near 2% over time, which is the Fed's goal. Why is it important? It matters because expectations shape behavior. If people expect inflation to stay high, businesses raise prices faster and workers demand bigger wage increases, and that can keep inflation going. If expectations stay anchored, inflation is less likely to spiral. So the Fed is betting that a small cut can support jobs without causing a new inflation wave, as long as expectations stay calm and Fed stays alert. To make it clear, here the Fed is talking about the long-term inflation expectation. Consumers expect that the short-term inflation will be around 3 to 4% over the next year. Okay, so if that's the logic, what is the Fed actually aiming for in the bigger picture? The Fed is aiming for a soft landing. What is a soft landing? A soft landing means inflation cools without the economy falling into a recession, and the Fed's forecasts show that's what they are aiming for. Here is the 2026 projection. The GDP growth will be around 2.3%, unemployment rate will be 4.4%, and inflation will be around 2.4%, which is like moving towards the target of 2%. But Paul, the Fed chair, also made a key point. There is no risk-free path because these two goals, jobs and inflation, are always in tension. Okay, so that's the Fed's logic. Now let's bring it back to real life and what this could mean for households. For households, lower rates can ease borrowing cost over time, but the biggest goal is job stability. Here is how it can show up. For loans and mortgages, over time, lower policy rates can reduce borrowing costs through financial system. For credit cards and small businesses, easier financing conditions can support spending and investment. For jobs, A softer labor market often hits low and middle income classes first. The Fed is trying to prevent a deeper slowdown. So the bottom line is, this is a cautious bet. If inflation stays calm and hiring improves, it is close to a win-win. If inflation hits up again, the Fed can pause, slow cuts, or reverse course. In my next video, I'm going to map exactly where this rate cut shows up first in real life and who benefits early versus late. If you want to see how cheaper money does or does not reach working households, stay tuned and subscribe to my channel. Thank you.